News surrounding the supply of Russian oil has been moving markets lately, and we're here to break down what exactly is going on and the projections for the oil price with our expert here today. He is Bob Ryan, Chief Strategist of BCA Research's Commodity and Energy Service. Welcome back to the show, Bob.
Thank you, David. Pleasure to be here. Thanks for having me.
Thanks for being here. And now, Bob, let's start with recent news coming out of Europe. On Thursday, we had Germany announcing that they are no longer opposed to the idea of an embargo on Russian oil. This is a change in stance because previously they were opposed to a full ban. Germany was heavily reliant on Russian oil. But it seems that the report stated that they've reduced their dependence on Russian imports from 33% of total German supply down to about only a quarter. So now I guess they're feeling a little more confident in their independence away from Russian oil, and now they're saying that it's possible, or they're looking into the possibility of a Russian oil embargo. Bob, why has this been moving the markets? Why is this significant to the overall global oil market?
The first thing that one thinks of when hearing that Germany is no longer opposing the embargo and the other EU states are moving in the same direction is the threat that Alexander Novak made in March. Was saying that Russia would immediately cut off natural gas exports if the EU were to cut off oil imports. This is really important. At one point, fairly recently, the EU accounted for almost half of Russia's oil exports, which amount to anywhere from 4.75 million barrels a day to maybe 5 million barrels a day. So they're looking at and Germany being the biggest part of that, they're looking at a loss of a lot of volume that would have a very difficult time quickly finding a new buyer. So what would happen, and what Russia sees is the oil that's on the water probably, if it isn't discharged one last time, it stays on the water. It becomes floating inventory until they can find a home for it. But that also means that ships aren't lining up to take oil on back in the Russian ports. When that happens, the pipelines, bringing the oil down from Siberia to the ports begin to back up. They fill up, and then they've got no place else to go. There's very limited inventory in Russia for storing oil or products. So they will reach a point quickly where they've run out of inventory. They have no what they call ullage in the system, meaning space to continue to fill oil. And once that happens, the only alternative they have is to shut down production.
Right. Another issue, but related as well, is that Poland and Bulgaria this week have seen their natural gas supply shut off from Russia. They've refused to pay for their natural gas in rubles, which was their demand, which was the Russians' demand before. How reliant is Europe on Russian oil and gas? You've seen Germany now switch their stance and their tune. I'm just wondering whether or not the Europeans, Germans, Polish aside, the greater European Union, they have an alternative to energy supply besides the Russians.
Replacing the lost oil or the embargoed oil is probably an easier, ask here. It's not as hard a lift for the world market. Replacing their natural gas imports should the Russians cut them off in the event that they cut off the oil imports. That's much more difficult. The interesting thing about Russia cutting off Poland and Bulgaria is that unlike Germany and the rest of the EU, that Poland is not dependent on Russian imports of natural gas. Beginning in around 2010, they started building out their LNG import capacity. And that's up and running and fully functional. So, they're not in the same straits that the Germans are. Their storage, last I checked this week, stood at about 60% of the 5-year average level of storage in Poland. And that leaves them in a distinctly different situation to the rest of Europe. Germany has chartered 3 floating regasification vessels. So, they can take LNG and turn it back into gas and then pipe it into the German mainland. And they can use that to power their economy as well as fill storage for next winter. But that takes time, and that's a limited source of new supply. It's really difficult, for these guys to mobilize, as quickly as they need to, in the event of a cutoff of Russian gas due to this embargo of oil.
How is OPEC responding to threats of limited supply from Russia? Are they stepping up to the plate and increasing production or not?
Not that we can see. It was really interesting. In our last research report, we wrote about just the tone of the monthly oil market report that OPEC publishes every month. And, it was really instructive. They refer to the war in Ukraine as the Eastern European conflict, or, something to that effect, anything but war. They follow the Russian predilection for calling it something other than war.
Yes.
So it would indicate to us that they are maintaining solidarity with Russia right now. And that, I think that's part and parcel of a new messaging from OPEC Plus, particularly the Saudis and the UAE by extension. It reflects how frayed the relationship is between the U.S. and Saudi Arabia and the Gulf states diplomatically. So we'll see.
Just on that note, real quick, and I'll come back to oil production, the diplomatic ties between the Saudis and the Americans, you mentioned that a deterioration of the relationship. Did this start before the war in Ukraine?
Yes, I think it started almost immediately with Joe Biden's campaign. When he said that the U.S. should, work to make Saudi Arabia a pariah for the murder of Adnan Khashoggi, or not Adnan, Khashoggi, the journalist writing for the Washington Post.
Okay, interesting. So there's definitely a geopolitical dynamic here at play. Now, going back to the oil production crisis happening in Eastern Europe, do you think the Americans now are looking to step up oil production in, I guess, solidarity for the West? U.S. shale and gas producers, are they increasing production or changing their outlook on production at all?
Yeah, we have shale oil production going up this year, and total lower 48 production in the U.S. going up, maybe 750,000 barrels a day, something like that. Similar amount for next year. We get shale production up to about 10 million this year, and slightly more than that next year. The big driver now, and this is really important, the shale guys are prioritizing shareholder interest before anything. And that is because they have spent decades destroying capital, and investors essentially abandoned them. And they, were, at risk of being excluded from external financing. It was that bad. So they've, taken to heart that they have to return capital to shareholders. So you see more share buybacks, you see CapEx going down and dividends going up, buybacks going up, all to make their equity more attractive. That is going to stay in place. They will need access to the capital markets for decades to come, even during this energy transition.
Right.
And they're not going to jeopardize that.
You brought up a good point. I guess on the corporate side, major gas producers don't have much of an incentive to bring down the price. But on the other hand, you've got midterms coming up, Bob, and the American people are really upset at inflation. And the government is probably getting a lot of pressure to try to do something about this increase in energy costs. So do you think the government and around the world, not just in the U.S., but the governments around the world and the corporate board leaders of these gas companies, oil and gas companies, are having some sort of dialogue to come to a consensus here, or not?
I don't think they're in dialogue, but I do think they all, as you say, they all are very, very, very sensitive to their electorate. It's interesting. This ties back to the deterioration of the Saudi-U.S. relationship
Yes.
that we were just talking about. The Biden administration spent more than a month, pleading with what we call core OPEC guys. So that'd be Saudi, UAE, and Kuwait to a smaller extent, to increase production to make up for the shortfalls in the amount of oil that OPEC Plus was returning to the market. That fell on deaf ears. And, we strongly believe that the release of the SPR barrels is a reflection of the fact that this dialogue broke down, and the Saudis in the US no longer see the world the same way. So in the event, what you got was 1 million barrels a day being released from the US SPR crude oil reserves over 6 months. And you've got another 60 million barrels, I think, coming out of IEA product inventory. So the net of this is going to be 1.3 million barrels a day of supply. It's essentially inventory transfer. It's coming out of the SPR inventories of the US and the IAE member states, ex-US. So what you get is new, air quotes, supply of 1.3 million to cover that hole.
I see.
That'll be replaced. Theoretically, that could go on forever, but I don't think that's what the long-term plan is here. And as I said, you've got IEA releasing its SPR as well. So that includes European governments, that includes Japan and Korea and all that.
Well, it's interesting how you noted in your report that a lot of the decrease in Russian oil production comes from the sanctions that have limited their ability to produce. I wonder if the increase in oil prices have put pressure on the U.S. government to, I guess, ease up on these sanctions for fear of rising inflationary tensions that could really rile up the population. In essence, should they lessen the sanctions, maybe the Russians would resume their normal rate of production and help lower the cost of oil a little bit?
I think, taking the war to Russia economically is the top priority of the U.S. government right now. And part and parcel of that is these sanctions.
Okay.
The Ukraine war.
All right. Very good. So let's put all your, all these supply and demand factors together and present your outlook on oil. Do you think that tightening supply is going to continue, I guess, and put pressure upwards, or do you think demand will fall dramatically because of A, the war in Ukraine, and B, I guess, COVID coming out of China, that it would sufficiently offset any tightening of supply? What's going to happen to the price, in essence?
What's really remarkable here, David, is the decrease in demand is being matched by that, or the decrease in supply is being matched by a decrease in demand. That's largely coming out of, the China COVID experience that we're going through right now. And a slowing, you saw U.S. growth negative for the first time in the first quarter of this year. So a general slowing, in the face of, the more than likely the high commodity prices, inflation, central banks' efforts to rein inflation in. But, overall demand is coming down, and as supply is coming down. So we found that really interesting. That likely persists, for most of this year. The market will be on either side of being, perfectly balanced, by very small degrees, unless we get a shock. So our expectation is that Brent crude oil prices are going to average $94 a barrel this year and $88 a barrel next year. That's our base case, and that's equilibrium. There's an enormous amount of uncertainty in the market right now, and that forces participants in the market to include a risk premium to cover that uncertainty. So we think there's anywhere right now from, 10 to 20 bucks a barrel, depending on when you're looking at it, of pure risk premium in the oil price that we observe.
Okay, so 94 this year and 84 next year. That's lower than what we currently are seeing. Just to present a counter argument, Bob, don't you think that should China reopen its economy eventually? I mean, I don't expect Shanghai to be locked down forever, but eventually when things open up, don't you think aggregate demand would kick back up, supply chain issues would fix themselves, and we can see potentially Brent spike up above 100 and stay there? Is that possible?
Yeah, I think, that's likely, but keep in mind the other provinces in China are now dealing with this, Omicron variant. I think it's the BA4 and the BA5, which apparently are more highly transmissible. And there's evidence, I've been reading this week, evidence that they are capable of evading the human immunity responses. So, the antibody responses that humans produce after they've been infected by other strains of COVID, or, with their mRNA vaccines. So this is another element of that uncertainty. And the other element of the uncertainty also is what does happen if the Europeans embargo Russian oil and they're not importing it anymore? Do they, cut off the nat gas supply? In the first instance, if that oil is embargoed and it can't be placed elsewhere in the world, and they end up filling their pipelines, filling their storage in Russia, and they have to shut that down, oil prices could dramatically increase.
Yes.
We've run some simulations that could take them over $140 a barrel.
Yes.
In that event. The other thing would also be,
it's not your base case, though, right? It's not just
that's not the base case.
Okay.
And the other thing is on the nat gas side, that is, potentially, more important than what's going on in oil. Because if they lose the nat gas that comes from Russia via pipeline,
right,
they're going to have to start shutting down heavy users of nat gas in Europe and prioritize human needs first. And that would almost surely be recessionary.
So we've got a few minutes left. Let's link it back to precious metals and your outlook on gold. Now, $94 a barrel. What is the Fed going to do in response to inflation, given your outlook on oil, given your outlook on what that's going to do to inflation, and finally how the PM's gold and silver would be impacted?
Well, the Fed's signaling 250 basis point hikes in the next set of meetings that they have. And I think that's what the market is pricing to right now.
Yeah.
I think that does, gradually start making it much more expensive to borrow money, which at the margin takes demand down a little as you go through that process. And I think the Fed will probably stay the course on that. As far as the gold and silver go, it's been really interesting, when we had these, we have these volatile episodes. And, gold recently within the past month, I think, traded up to about $2,060 per ounce. And then just this week, it fell down to 1,890 thereabouts per ounce. It's all over the place. It's not performing as the safe haven that it typically is when you get this level of geopolitical uncertainty. But that is, for good reason, because the uncertainty and the fear that's in the market right now, is making people rush to dollars. So dollar is the ultimate safe haven right now. Strong dollar translates into weak gold. It makes the local currency cost of all commodities more expensive. And the buyers of precious metals in the two largest gold markets, for example, in China and India, the actual cost of that gold for them in local currency terms goes up even more than what we're seeing here, as the dollar price. So I think that the dollar demand is going to keep the gold price rally in check. However, there's always going to be this store of value demand for gold. So central banks will hold it. family offices will hold it. Banks in general will hold it. Individuals will hold it as a store of value because, if you get a, runaway inflation, you have gold, you can use that, to purchase what you need to purchase or to, transact. And if you get deflation and you get a collapse in the economy, gold holds value as well.
Right.
So as a store of value and purchasing power, it still will function, but the dollar is going to definitely blunt the price appreciation you would expect from the safe haven demand.
So gold's upside this year will be limited by the dollar. Well, excellent thoughts, Bob, on both gold and oil. So I look forward to speaking with you again next time. Thank you very much.
Thank you, David.
Thank you for watching Kitco News. I'm David Lin. Stay tuned for more.